This video discusses amortization of intangible assets, as well as changes in estimates related to depreciation and changes in depreciation methods. Amortization of intangible assets typically follows a straight line approach. When doing your straight line calculation, remember that you have your amortizable base on the top, which is cost minus residual value, and you have the useful life on the denominator. The useful life of an intangible asset is typically limited to the legal life of the intangible asset, or perhaps the contractual life or regulatory life of the intangible asset. So for instance, a patent has a legal life of 20 years. Now, that provides an upper bound. So that means that it can't go longer than what the legal life would be. However, it could be less in given situations. For instance, if technological change would render a patent useless after 10 years, well, then the life that you would use as the useful life would be 10 years, not 20 years. Or perhaps you intend to sell the patent, well, then the useful life would be shorter. Or perhaps you bought the patent from someone else who's already used up part of the legal life. Well, then the useful life to you would be shorter. So it doesn't have to be as long as the legal life, but it's at least bounded upward by the legal life. Intangible assets typically have a residual value that is zero, usually at the end of their life. Since their legal life is over, they don't have a value left. But if we intend to sell the asset prior to its end of its legal life, then it could have a residual value. As with all fixed assets, really, we try to match the cost allocation with the pattern of use for the asset that's generating benefit. Typically, like I said, this involves straight line. It doesn't have to. You're going to see some options that you have under amortization for things like software development costs. As an example of amortization, we have Hollins Corporation that began operations in 2021. Early in January, the company purchased the following two intangible assets. One is a franchise from Ajax Industries for $200,000. The agreement's for a 10-year period, and they purchased a patent of $50,000. The remaining legal life is 13 years. However, due to an expected technological obsolescence, the company estimates that the useful life is only going to be 8 years. Hollins uses straight line amortization method for all intangible assets. The company's fiscal year is December 31st. So our journal entry for the franchise, to begin, is going to be debiting the amortization expense and crediting the asset itself. This, again, is typical like depletion. It was typical where we don't use a contra asset. That's not to say that we can't. You are also able to use a contra asset, so it will be accumulated amortization. And that was actually the method that was shown in your Accounting 111 tax. So either option is acceptable, but the typical process is to directly credit the asset. And this, again, goes to the nature of what that asset is. If it's going to have a zero value at the end of its legal or contractual life, then it makes sense to reduce that asset down so value is more tied to the actual using up of that asset than something like a fixed asset that's tangible, where it may not have the same decrease in value over time as the use that you're showing with depreciation. The calculation for the amortization expense is going to be the cost minus any residual value that we had. They don't tell us anything about residual value here in this problem, and then divided by the useful life. And this is, again, because we're following the straight line amortization. Same thing with the second journal entry we have for the patent. We have our costs and we divide by the useful life. Notice we didn't use the 13 years. We instead used the 8 years here. And the reason why is because the 8 years was the useful life. 13 years produced the upper bound in consideration of what could be amortized, but 8 years was the more appropriate due to the technological obsolescence. So again, the calculation is going to be the cost minus the residual value divided by the useful life, and then we debit amortization expense and credit the asset itself. As we stated a couple slides ago, our goal with the allocation method is to discover the pattern of use of the asset that's generating benefits. With software development costs, we have a couple considerations here. We could either amortize using the percentage of revenue method, which takes a proportionate amount of revenue that's been earned in a given year and uses that percent to record amortization, or we could use the straight line method. We choose the greater of the two. In this example, it says Astro Corporation develops computer software graphics for sale. A new development project started in 2020, reached the point of technological feasibility, and that's that point we talked about in Chapter 10, where we discussed that from then until when the software was actually released to the customers, those are the costs that we can actually capitalize. So it says they reached that on June 30th, 2021. The costs in 2021 were as follows. So prior to June 30th, right here, this is going to be expensed as incurred. So it's a period expense. But from June 30th, 2021 to December 31st, 2021, because on January 1st, 2022, it was available to the customers. So it was released to the customers. These costs are going to be capitalized. Says that they have the following information related to sales. We have $3 million that took place in 2022, and then over the next 3 years, from 23 to 25, we had $7 million. So the total over the 4 years is going to be $10 million. As we noted, we are going to expense that $1.2 million. So the question becomes, how do we amortize the $800,000 that's capitalizable? We'll calculate the two options that we have to do the amortization. So the first is the percentage of revenue method. We take the $3 million that we had in that current year and divide it by the $10 million in total revenue. This represents 30%. We multiply that by 800,000, and that represents 240,000 that could be amortized in the current year. The other option is to do the straight line method. Remember, they were going to have sales of this program, this software, for 4 years. So essentially what we would recognize is the same rate every single year. Remember, straight line gets its name because it has the exact same expense every single year. So if we divide by the 4 years, this represents 25%. So you can see right now which of the percentages is larger. The 30% is going to be larger. And we're multiplying by a static depreciable base, or I should say amortizable base here. So our comparison is either the 240,000 or the 200,000. We take the larger, therefore we recognize the 240,000 as our amortization. Remember that not all intangible assets are subject to amortization. If an intangible asset is an indefinite life intangible asset, we don't amortize it, but instead consider it for impairment. And we'll talk about impairment later on in the chapter. Most intangible assets are going to be amortizable. Those that are indefinite life, some examples are goodwill and trademarks and trade names. Trademarks and trade names, they have about a 10-year life on them, but you can renew them indefinitely. So we refer to them as an indefinite life intangible asset. And then goodwill is also an indefinite life intangible asset. Remember, it only develops under business combination. The next topic is changes in estimates. If you remember our conversations from an earlier chapter, I believe it was chapter 4, we noted that we handle changes in estimates prospectively. And that means that we're going to adjust the current period and all those periods going forward, but we don't do retroactive adjustments. In terms of note disclosures, we have to include information in the notes to the financial statements regarding the impact on net income as well as the impact on the related earnings per share. As an example here, we have on January 1st, 2019, that Hogan Manufacturing Company purchased a machine for $250,000. At the time of purchase, the company estimated that the service life was going to be 5 years and that the residual value was going to be $40,000. On January 1st, 2021, so this is 2 years later, the company revised its estimates to say that the service life was going to 8 years now and that the residual value was down to $22,000. The company's fiscal year end is on December 31st, and the straight line depreciation methods are used for all their assets. Depreciation for 2021 and the subsequent years is as follows. So when considering this change in estimate, that's what we're looking at right here. The first thing we have to do is consider how much depreciation has been recorded in the past. So we have a 5-year useful life originally, and we had $250,000 in cost. We had a residual value of $40,000. So $250 minus our $40,000 gives us a $210 depreciable base. So this was our original amount of depreciable base. We divided that by 5 years. This produced for us $42,000 per year. Multiply that by 2 years. This gives us $84,000 as our depreciation to date. So in order to calculate what our new journal entry is going to be in the future, remember we handle changes in estimates on a prospective basis. We take the original cost minus the depreciation we've recorded thus far. This leaves us with a net book value remaining. We then take out the new residual value of $22,000, and this is just simply calculating the numerator for a straight line depreciation. Remember, cost minus residual value is our numerator here, and that's all we're doing with these two pieces right here. So our remaining cost is $166. Our residual value is $22. This leaves us with a new depreciable base of $144, and then we simply divide that by the remaining useful life. Remember, we had 5 years originally. differently. We took up 2 years, 2019, 2020 is what we depreciated. So we now have switched to 8 years as our useful life. So we take 8 minus the 2 we've already recorded, and this gives us 6 years as our remaining useful life. And this gives us our new depreciation then of $24,000. So we do our journal entry like normal, debit depreciation expense, credit accumulated depreciation. Let's go ahead and try a quick multiple choice question. Pause this, and then we'll come back and do it together. This problem states that on January 1st, 2021, Esquire Corporation purchased equipment at a cost of $165,000. The equipment was expected to have a service life of 10 years and $15,000 residual value. Straight line was used, it says at the beginning of 2023, so after 2 years. The estimate of the residual value was revised from 15 to 0. And depreciation for 2023 should be what? So our calculation is going to start with 165 minus 15 because we have to calculate the original depreciation. We're going to divide that by 10 years. That was the original useful life. This gives us $15,000 per year. We then need to consider how many years we've depreciated. So there was 2 years, 21 and 22. So we'll take 15 and multiply by 2. That gives us 30 here. So now we're going to calculate what the remaining net book value is going to be. We take our 165, which is our original cost, minus the 30, leaves us with 135. And then we need to divide by the remaining years that we have for useful life. Remember, what the change was that of residual value. It said it went from 15 to 0. So we're not subtracting any new residual value out. The residual value went away. So all we're simply doing now is taking this remaining net book value and dividing by the remaining useful life. It was at 10 years. We used up 2 years, so now we have a remaining life of 8 years. So divide that out, and we have 16,875. This should be letter B. And just so we're clear, I truncated the zeros here, but you have these zeros too. Okay, the last topic is a change in the depreciation, amortization, or depletion method. This is handled prospectively, just like our other changes in estimates. One thing to note is that this change in estimate is achieved by a change in accounting principle, and this requires a clear justification in our notes disclosure. Because we're changing this estimate as a result of the accounting principle, we have to justify that change. So we don't have to justify the changes of the other estimates, we just have to indicate the impact. But when we have a change in estimate as a result of a change in principle, we do have to justify the change. As an example, on January 1st, the Hogan Manufacturing Company purchased a machine for $250,000. Company expects service life to be 5 years, residual value to be $30,000. Company's year end is December 31st, and it uses the double declining balance method. During 2021, the company switched from double declining balance to the straight line method. How is it that we handle this? Again, this is a prospective change that we're going to do, but the first thing we have to do is calculate the amount of depreciation expense. So to do this, we have $250,000 as original cost. We multiply that by 40%. Remember, this is the double declining balance method. You take cost minus accumulated depreciation and multiply that by 2 over the useful life. And the useful life was 5 years, so 2 over 5 is 40%. So we multiply these out. We have no accumulated depreciation in the first year, so it's just the original cost of $250,000. This gives us $100,000. We then calculate our second year's depreciation by taking the cost minus accumulated depreciation of $100,000, again multiplying by that double declining rate, and that gives us $60,000. So total depreciation expense recorded in the first 2 years, 19 and 20, is $160,000. This gives us a remaining net book value of $90,000. We're then going to switch over to the straight line method. And remember, the manner in which we calculate depreciation then changes. It's cost minus residual value divided by the useful life. So our net book value remaining is 90. We take out the residual value of 30,000. Remember, they tell us that up here. This gives us a depreciable base of 60,000, and then divide by the remaining life. Remember, they tell us that the service life was going to be 5 years. We've already accounted for 2 years, so we have a remaining life of 3 years. This gives us depreciation of $20,000 per year. So our journal entry debits depreciation expense and credits accumulated depreciation and handles this going forward the same exact way. All right, let's try one more multiple choice question. Go ahead and pause this and then come back together and we'll do it. Okay, this problem states on January 1st, 2019, Harrow Company purchased equipment at a cost of $400,000. The equipment was expected to have a service life of 10 years with a $20,000 residual value. The company's fiscal year end is December 31st. The double declining balance method was used at the beginning of 21. The company switched from double declining balance to straight line. In 2021, what would be the adjusting journal entry for depreciation expense? All right, our calculation we first have to do is the depreciation expense for the first 2 years. We're using the double declining balance method. So again, that's cost minus accumulated depreciation multiplied by 2 over the useful life. So our cost that we have is $400,000. For the first year, the cumulative depreciation is 0, as we just mentioned a moment ago. And then we'll multiply this by 2 over the useful life. 2 over the useful life is 20%. This gives us a depreciation expense of $80,000. We'll then do the second year. We'll retake $400,000. And now we have a cumulative depreciation of $80,000. So we'll back that out as well. Multiply by 2 over 10, and this gives us $64,000. We'll combine these together. We get a total of $144,000, leaving an undepreciated cost or a remaining net book value of $256,000. Our next step is then to convert over to our straight line calculation. So we'll take 256 and we'll minus our residual value, which they have as 20,000. So back this out. This gives us 236 as our depreciable base, and we'll divide that by the remaining useful life. We started out with 10 years. We've recorded 2 years. So this gives us 8 years remaining. And this calculates then to be $29,500. And this becomes our depreciation expense for the current year and those years going forward.